to Phillip Futures Market Watch. My name is Joyce Liu, Investment Analyst with Phillip Futures. Spot gold prices, upon which gold futures all over the world are pegged to, dropped a stunning 15% over 2 days, about 2.5 weeks ago. From the high of 1,564.36 on Friday 12 April, gold prices plunged more than $200 to reach 1,336.04 on Monday 15 April, and subsequently touched a 2-year low of 1,321.35 during early trading hours on Tuesday 16 April. In the 2 weeks thereafter, gold prices have corrected significantly, and the question that is now in every investor's mind is, where are gold prices headed? To address this question, we would like to examine 3 major fundamental factors driving the market right now. First, physical buying. Physical gold buying comes in the form of jewelry, gold bars, and coins. In the 2 weeks following the gold price plunge, strong physical buying is one of the major factors lifting prices. Since gold prices dropped almost $600 per troy ounce from its peak in September 2011, many investors snapped up gold jewelry and gold bars and coins. But the enthusiasm in the retail investors market was not mirrored in the gold fund buying market. The total amount of gold held in gold funds has declined sharply since early February. Despite the lower prices of gold now, fund outflow continues at a stunning rate of 0.6% a day, even after the 2-day price plunge. Total gold holdings held in ETFs and funds dropped from 68.266 million troy ounces on 15 April to 64.582 million troy ounces on 29 April. This is a 5.4% outflow in a span of 10 days. This mismatch between physical buying and fund buying could be the result of 2 scenarios: either a fundamental shift from fund buying to physical buying as an investment tool, or a disconnect in expectations between large institutional buyers and small retail buyers. The former suggests that the current support in gold prices may be sustainable, while the latter paints the gloomy picture of a possible collapse again when the buying power of small retail investors is exhausted. So first, we want to watch the source of physical buying. Second, central bank buying. Central banks hold gold bars and coins as part of their foreign reserves. The proportion of gold as part of the central bank reserves range from 0% to 76%. The bull gold market in the last 12 years have added investment income to central banks all over the world, but the recent plunge in gold prices had resurfaced the question of the intrinsic value of gold. While some central banks see the lower prices as a good buying opportunity for long-term investments, others see no intrinsic value in gold and contemplate cashing out of gold for more funding. After becoming net buyers for 3 consecutive years, will central banks turn net sellers again? The second factor we will be watching closely is central bank buying. Third, US economic recovery. Signs of economic recovery in the US have pressured gold prices to trade in a downward trend channel since October last year. As clearer signs of recovery started to show in early February this year, fund outflow of gold also accelerated. But recent economic data have been disappointing. With initial jobless claims and GDP growth both worse than expectations, the question on every investor's mind is whether US economic recovery is on track. If economic growth continues, we may see further movement of funds away from gold into other cash flow yielding assets. But if the nation slumps into another recession or jumps into a high inflation environment, investors' attention may be refocused back to gold. So the third factor we are keeping a close watch on is US economic recovery. On to the technicals. On the hourly chart, the upward movement since 16 April resembles a corrective upward trend of the impulsive downward movement prior to that. This corrective upward movement met with resistance at 2 levels, the critical psychological level at 1400 and the 38.2% Fibonacci retracement level from the 1590 high on 9th April to the 1321 low on 16th April. Prices are now range-bound between 50% and 61.8% Fibonacci retracement levels, more likely to break down than up. If prices break on the downside, they may meet with some support at the previous low of 1405 and psychological level at 1400, breaking which prices may make new low below 1321. However, if prices break on the upside, resistance level will be at 1500 and 1564, breaking which we may make a new high. For more information on the risks and returns of investing in gold and gold futures, please approach any representative from Phillip Futures for further discussion. Thank you, and please stay tuned for more Market Watch videos.